But during the financial year, you still need to buy in more stock in order for you not to disappoint your customers as units. And then we sold 3,050 units. So how many units are we supposed to have as our closing stock? The units of our 239,300. There is your gross profit. All right. Good morning, good afternoon, good evening, wherever you are watching me from. Here is accounting class, still with maa'm Tutu. Still on the same topic, stock valuation. Today we are going to consider the three methods of stock valuation. But particularly, we are going to look at one of the methods. Now, for stock valuation, we have three basic methods that we are going to consider for grade 12. And the first method is what we call the first in, first out method, or what you regularly call the Fifo method. The first F stands for first, I stand for in, the next F stands for first, and O stands for out. So first in, first out method. The first in, first out method is the stock valuation method, whereby the first set of goods that we buy into the business will be the first set of goods that we sell out of the business. The first goods to come in will be the first goods to be sold out. Invariably, that means that the last set of goods that we buy into the business will form our closing stock. The last set of goods that comes into the business, meaning the recent set of goods that we buy into the business, will now form our closing stock. So when we are looking at the value of closing stock using first in, first out method, we consider the recent goods that are bought into the business. So the closing stock value is more realistic as it uses the costs of the last batches of goods that were purchased into the business. And then you find out that the cost of sales will be relatively low using the first in, first out method. Why? Because the cost of sales were calculated from the first, second, or the earliest batch of goods that were bought into the business, and which can be relatively low. So when we consider the first in, first out method, we say that the costs of sales will be calculated from the goods that were bought into the business first. Because if we are looking at the first in, first out method, the opening stock will be the first set of goods that we sell out, followed by the next goods that were purchases. That were purchased. So what are we saying? In using the first in, first out method, we consider the date of purchases. So I want us to quickly look at a question, an example, a question adapted from November 2018. A question adapted from NSC November 2018. And the name of that business is Vuisile Suitcase Shop. Chabile Vuisile sells travel suitcase. The year end is 30 June 2020. You are required to calculate the closing stock on 30 June 2020 using the first in, first out method. Tabile suspects that suitcases have been stolen. Provide a calculation to support is concerned. And then the third question says, tabule is concerned about the volume of stock on end. So you have to calculate how long is closing stock expected to last. That is the stock holding period. And then state one problem with keeping too much stock on end and one problem with keeping insufficient stock on end. On the screen, you will see the information of Tabule's shop. You will see the information on the screen. We have our opening stock. The unit of the opening stock is 420 and the unit price is 2,175 and with a total of 913,500. Our closing stock, the unit of our closing stock is 496, and then we are to determine the value of the closing stock. Then you can see the purchases. The total purchase stands at 3,155 units, and then we bought the first set of goods in September 2019. The second set of goods was bought in December 2019. The next one was bought in March 2020. And then June, we bought in June also 2020. And then we were told that 25 goods were returned from the goods that we bought in June. So your sales is 3,050 traveling suitcases were sold, and each was sold for 4,200. So let's go to the first question. The first question says we should calculate the closing stock on 30 June 2020. We are calculating closing stock on 30 June 2020. And remember, we said the first set of goods that we bought into the business will be the first set of goods that we sell. Invariably, it means our closing stock will come from the recent goods that were bought into the business. Now, looking at this question, the recent goods that were bought into the business will be the one for June 2020. In June 2020, the business bought 450 goods. That is the total unit of goods bought into the business. And out of the 450 goods, 25 were returned to the supplier. So invariably, in June 2020, we have 425 goods. Now, let's calculate our closing stock. The unit of our closing stock units, the unit of our closing stock was units equals 496 units. We have 496 units that we need to calculate the value. So the first set of goods that we are going to consider here will be the last goods that were bought into the business. And if you look at June, we said we bought 450 and we returned 25 stock. So meaning that we are only left with 425 stock. And then we multiply that amount with the unit price, which is 3,040 to get the amount. So we have taken care of 425. How many units are we looking for here? We are now looking for 1 and then 71 units. We are now looking for 71 units. Now, the last 71 units will now be taken from the stock that we bought in March, in the month of March. So it means that out of 875 stock that we bought in March, 71 units is still remaining as the closing stock. So I move to March, and then I take my 71 units from March. The unit price for March is 2,930. So once I get the calculation of these two, then I'm able to get my closing stock. So let's do the calculation. 425 times 3,040. If you do that calculation, that should give me 1,292,000, and then I have 71 times 2,930. That calculation should give me 208,030. So if I calculate the two amounts, I will get the total for my closing stock for 496 units. When we now have the addition of these two, we're going to have 1,292,000 plus 208,030. And that will give me a total of 1,500,030. And this becomes the value of closing stock. That becomes a value of closing stock. So the value of closing stock for Tabile suitcase business as at June 2020 is 1,530. Right. So the next question says, Tabile suspects that suitcases have been stolen. Provide a calculation to support his concern. Now, suitcases are in units. So Tabile is concerned that some of the suitcases were stolen. So we need to calculate how many suitcases are we supposed to have as the closing stock. When we have the number of suitcases we are supposed to have as the closing stock, then we consider, is that the amount of suitcase that is presented to us as the closing stock? If yes, then there is no stock missing. But if no, if the amount is more than our closing stock, then there will be stock missing. So let's calculate the units of stock missing. Units of missing stock. In calculating this, you consider first your opening stock. How many opening stock do we have? Okay, let's have the formula to this. We look at our opening stock. Opening stock. We add our purchases. We add our purchases. We less our returns in units. We less our returns. We less our returns, and then we less the number of sales units. We minus the units sold. And then when we do this, we are supposed to get our closing stock. So let's consider this. Our opening stock, the unit of our opening stock is 420, plus the total units purchased was 3,155, And then we took back to the supplier 25 units, and then we sold 3,050 units. So how many units are we supposed to have as our closing stock? The units of our closing stock is what we are about to calculate. Plus 3,155 minus 25 and minus 3,050. The unit of our closing stock is supposed to be 500 units. Our closing stock is supposed to be 500 units. But look at what was given to us. Our closing stock was given as 496 units. So 500 units minus 496 units will give us our missing stock. So missing stock will be equals to 500 minus 496 units, and that will be 4 suits cases. So your missing stock is 4 suit cases. Now the next question is asking us to calculate how long stock is expected to last. How long is stock expected to last? So, and that means we are looking at our average stock holding period. Average stock holding period. There is a formula for that. Let's see the formula for average stock holding period. Still on Fifo method, average stock holding period. So our average stock holding period is equals to our average stock over cost of sales times 365 if you are looking for days. But if you are looking for months, you multiply by 12. So our average stock holding period is average stock over cost of sales times 365 days. So it means that we need to calculate what is our cost of sales. Obviously, your average stock, when you say something is average, it's in the half, it's in the middle. It means you are taking your opening stock plus your closing stock, you divide by 2. That will be your average stock. But for now, we have to calculate our cost of sales. We consider the periodic inventory system. So in considering that, we calculate our cost of sales. So let's get our cost of sales. Remember, in the last episode, we said to calculate your cost of sales, you need to consider your opening stock, you plus your purchases, you minus your returns, and then you minus your closing stock. You minus the value of your closing stock. So here we are going to consider our cost of sales. Our opening stock here, our opening stock is 913,500 plus our purchases. When you check your total purchase stands at 8,460,850. We minus our returns. Our total returns is 76,000. Then we minus our closing stock. which is 1,530,000. So our cost of sales will be, let's compute that amount. Let's calculate 913,500 plus 8,460,850 minus 76,000 and minus 1,530,000. So our total cost of sales stands at 7,798,320. 320. So this is our cost of sales. So now we want to consider the average stock, and the average stock holding period. The average stock holding period for this business. So we're going to calculate that. We're going to say, just to substitute this equation here, the average stock holding period. Now, the average stock holding period asks for here, they said, calculate for how long is the closing stock. So the average stock holding period here is only for the closing stock, not for the total stock. So in that case, we are only going to use the value of our closing stock here, which is 1,530,000 divided by 7,798,320. Then we multiply that by the number of days. So let's calculate that. 1,530,000 divided by 7,798,320. Then multiply by 365 days, and that should give us 7,20 days. 70,21 days. 70,21 days will be our average stock holding period for our closing stock. Now, the next question says we should state one problem of keeping too much stock. One problem of keeping too much stock is that the stock can become obsolete. It means the stock can expire, or the stock can go out of fashion. And then another one says we should state one problem of keeping insufficient stock on hand. It means you will not be able to meet the needs of your customers. You will become unreliable to the customers. And this is me for today. Please feel free to send your questions and any queries on the YouTube page displayed on the screen. And also, please send your questions to the WhatsApp line, displayed on the screen. The next episode, we are going to be considering the weighted average method. Thank you, and bye for now.